The U.S.-Iran standoff has pushed Brent crude to a 4-year high of $112 a barrel, while the Indian rupee has crashed to a record low of 93.71. Leaving an investment portfolio on autopilot during a period of such extreme global index drops guarantees capital destruction. We are going to run a 5-minute stress test on your portfolio. The objective is to pivot away from bleeding sectors and reallocate into defensive assets that are mathematically positioned to profit from this exact shock. Open your portfolio application immediately and locate your sector allocation breakdown. Please note, this is an educational simulation based on March 2026 data. You must consult a SEBI-registered financial advisor before making any actual trades. Surviving severe geopolitical shocks requires shifting from passive observation to active, data-driven reallocation. Step 1. Identify any holdings you have in import-heavy companies. Specifically, scan your list for aviation, logistics, or paint manufacturers. Crude oil is the single largest macro risk to the Indian market right now because of the immediate military threat to the Strait of Hormuz. 60% of India's crude oil must pass through this specific geographic bottleneck to reach domestic refiners. This chart shows the domestic inflation math linking global conflict to local policy. Every $10 rise in crude oil adds 30 to 40 basis points to India's Consumer Price Index, or CPI. The CPI is a metric that measures the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services. Any portfolio heavily reliant on cheap oil or stable inflation is currently compromised. These positions must be trimmed. Step 2. Categorically separate your financial sector holdings into private banks and public sector undertaking, or PSU, banks. Foreign portfolio investors, or FPIs, which are non-resident entities investing in Indian financial markets, have drained 88,180 crore rupees from the market this month. 60% of that selling is concentrated directly in financials. Specific institutional instability is dragging down the index. HDFC Bank dropped 2.15% following the firing of 3 senior officials in their Dubai branch. This chart shows the split in banking resilience. The private sector is flashing red, while PSU banks are up 2.07%. Government capital allocation supports these public banks, insulating them from the foreign selling pressure destroying private bank valuations. Heavyweight private banking exposure must be reduced until confirmed foreign capital buying returns to the sector. Step 3. Take the capital freed up from private banks and reallocate it strictly into defensive export-driven assets, specifically IT and pharma. The Indian rupee dropped 1.10 rupee in a single week, hitting a record systemic low of 93.73 against the US dollar. This diagram shows the currency math formula. Every 1% drop in the rupee acts as a massive tailwind, delivering a 50 to 80 basis point boost to the EPS of exporters. EPS stands for earnings per share, which is a company's net profit divided by its outstanding shares of common stock. Even as U.S. tech stocks on the Nasdaq fall, Indian IT stocks surged 2.17%. The currency shield is actively working. A crashing domestic currency is a systemic risk, but it becomes a highly measurable mathematical advantage if you position your capital in export sectors. Step 4. Immediately set mechanical stop-loss and limit orders based on the pending 48-hour ultimatum the U.S. issued to Iran. The India VIX is sitting at an elevated 22.81. The VIX is a volatility index that measures the stock market's expectation of volatility based on options pricing. At this level, fast and violent intraday market swings are a mathematical certainty. This chart shows the Hormuz contingency matrix, detailing the 3 specific Monday market scenarios based on the geopolitical outcome of the ultimatum. If Iran complies, expect a relief rally. If the standoff continues, set brackets for a choppy market between 23,000 and 23,350. If Iran escalates, set hard stop losses for a gap down below 22,650. Setting pre-calculated automated contingency orders is the only way to remove human emotion and panic from Monday morning's opening bell. You have now trimmed the dead weight in private banks, aggressively overweighted IT and pharma to capture the rupee crash, and deployed hard stop losses. Over the weekend, aggressively monitor the Brent crude ticker and the DXY. The DXY is the US dollar index, a measure of the value of the US dollar relative to a basket of foreign currencies. These are your leading indicators for Monday's open. Market volatility is simply data moving at high speeds. Having a systemic, mathematical plan dictates how portfolios survive. This concludes the stress test protocol. Remember, these are strategic frameworks. You must consult your personal financial advisor before executing any trades.